Welcome back, everyone. Last time, we navigated the complexities of merchandising operations and gained a solid understanding of the multi step income statement. As you recall, a crucial element in those discussions, and indeed for almost any business that buys and sells products, is inventory. This week, we're dedicating our time to Chapter 6, all about reporting and analyzing inventory. It's a fundamental topic that impacts a company's financial statements significantly. So, what exactly is inventory? And why is it so important? Well, for a merchandising company, inventory is pretty straightforward. It's the merchandise inventory they have on hand, ready to sell. But for a manufacturing company, it's a bit more involved. They categorize inventory into three stages: raw materials waiting to be used, work in process, which are partially completed goods, and finished goods that are ready for sale. Regardless of the type of company, all these inventories are reported as a current asset on the balance sheet. A key challenge is determining the inventory amounts at the end of an accounting period. This typically involves a physical count, where companies literally count, weigh, or measure every item on hand. This isn't just about getting a number. It's vital for checking the accuracy of records, identifying any lost inventory due to theft or waste, and for calculating the cost of goods sold if a periodic inventory system is used. Beyond the physical count, we also need to confirm ownership of goods. This can get tricky, especially with items that are in transit. We explored terms like FOB, shipping point, where ownership transfers to the buyer as soon as the goods leave the seller, versus FOB, destination, where ownership only passes when the goods arrive at the buyer's location. We also look at consigned goods, which are held for sale by one party, but still owned by another. It's crucial to get these distinctions right, as ignoring goods in transit or consigned goods can lead to significant miscounts and misstatements of inventory. Speaking of efficiency, we discuss inventory management philosophies like just in time or JIT inventory. This method aims to significantly lower inventory levels and costs by producing or purchasing goods only when they're needed. While highly efficient, JIT isn't without its risks, as recent global events like supply chain disruptions have clearly demonstrated. Once we've determined what inventory a company owns and its quantity, the next big question is, how do we value it? This is where inventory cost flow methods come into play. We delve into three primary assumptions: first in, first out, or FIFO, which assumes the earliest goods purchased are the first ones sold; last in, first out, or LIFO, which assumes the latest goods purchased are the first ones sold; and average cost, a method that assigns costs based on the weighted average unit cost of all goods available for sale. It's fascinating to see how these different methods can have a significant impact on a company's financial statements, particularly on cost of goods sold, net income, and even taxes, especially during periods of rising prices. For example, in an inflationary environment, LIFO generally results in lower net income and lower income taxes because it matches the most recent higher costs against current revenues. On the other hand, FIFO tends to result in higher net income under the same conditions. We also explore the LIFO reserve, which is a disclosure that helps analysts compare companies that use different inventory costing methods. Another important valuation principle is the lower of cost or net realizable value, or LCNRV method. This conservative approach dictates that if the value of inventory falls below its original cost, perhaps due to damage or obsolescence, it must be written down to its net realizable value, which is the expected selling price minus any costs to complete and sell. Finally, we round out the chapter by looking at the analysis of inventory. We introduce key metrics like inventory turnover, which measures how many times, on average, a company sells its inventory during a period, and days in inventory, which tells us how long inventory is typically held. These ratios are crucial for assessing a company's efficiency and liquidity, and modern data analytics tools are revolutionizing how companies manage and optimize their inventory. And before we wrap up this chapter, we also touch upon the serious implications of inventory errors. A miscount or incorrect valuation of ending inventory, for instance, can not only distort the cost of goods sold and net income for the current period, but can also have a reverse offsetting effect on the net income of the subsequent accounting period. These errors can also impact the assets and stockholders' equity on the balance sheet. Understanding the importance of getting inventory right and what can go wrong when we don't sets us up perfectly for what's next. In our next episode, we'll move into fraud and internal controls. We'll look at how companies protect their assets, prevent fraud, and make sure their financial reports are trustworthy, all of which ties directly back to what we've been talking about with inventory accuracy. So that's a wrap on reporting and analyzing inventory. I know it can be a tricky chapter, but it's packed with tools that help us really understand a company's operations. Take your time reviewing the details, practice the examples, and as always, ask questions if you get stuck. You're doing great, and I'm proud of the progress you're making.